Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer. Things have flattened out in the last 30 minutes, but not without its volatility since morning. So first we had the fall from the high and then that little bit of a recovery. But right now it's absolutely unchanged on the Nifty and the Sensex. Midcaps under pressure. The midcap index down 350 points. Hi.
Good morning, Reema. Like you mentioned, extremely volatile trading session, but it's a trading session where the broader end of the markets continue to underperform. The small cap index continues to trade with cuts of over 1%. What's leading to the fall today? Well, the entire pharma pack is under quite a bit of pressure, and some of the heavyweights over their names like Dr. Reddy, that particular stock seeing quite a bit of a sell-off. Syngene, a guidance cut coming there from the management for FY25. That stock was under pressure. The MFIs, SFBs, two companies that came out with results yesterday, or two banks, MFIs that came out, that is something that didn't really encourage the street in terms of the outlook. And all of those stocks, Spandana Spurti, Spuryo, Small Finance, all of them trading with deep cuts today. And Tejas Networks, a stock that you track, even that particular stock under quite a bit of pressure. So overall, very sharp reactions to what is essentially a muted set of numbers. And some of the mid-cap IT names, yesterday that were flying away, but post-market hours, some results that came haven't really, encouraged the street so much.
Indeed. So Science is down nearly 18%. Even Mphasis, where the company is talking about above industry growth rates, their large deal pipeline is up 50%. They won the highest deals that they have in the last 6 quarters. So despite all those encouraging signs, the stock is down 5.5% because of that little bit of a revenue miss. So the street is, after the kind of outperformance Mphasis has had in the recent past, there is no room for error, and markets are quite unforgiving. But other than that, you've got cuts coming through in a Mastech, a Birlasoft, FirstSource, CNBC-TV18 These are companies still to come out with their numbers. And ahead of that, there is some selling pressure. But other than that, some of these new age tech companies are also under pressure today. So Go Digit is down nearly 4%. Ola Electric, and Swiggy, Zomato, these stocks are weaker in trade. And keep your eye out on Industars. Industars is currently up close to about 1.5%. While the numbers show a big jump in the company's margins and profitability because they got 3,000 crore of a receivable from Vodafone Idea. If you strip that out, the numbers are in line with expectations, and Industars as a stock has been outperforming for the last couple of days, which is why today you're not seeing that big reaction in the stock price. But Syngene is a stock on our radar. They reported a good set of Q3 numbers, margins expanding, consolidated EBITDA up 22%. We have with us Jonathan Hunt, MD and CEO of the company. Jonathan, thank you for joining in. Now, the company has revised its guidance for FY25 from a high single to low double-digit sales growth to a single-digit revenue growth. So what's the growth outlook looking for Q4, and why have you downgraded your guidance?
As you'll recall, the first half of the year, quarter one, quarter two, both minus 2% on revenue growth, so a little bit of degrowth, and very much pinned to what we were seeing going on in the US biotech sector about the challenges they were facing with raising fund, refinancing, and if they don't raise funds easily, they can't spend it. It doesn't filter through to their expenditure with us. And we took a view at the beginning of the year. We thought that would stabilize. We thought it would recover, and I thought it would happen sort of end of quarter two into the middle of the year. It took a little bit longer than I expected, but directionally we were right. So we've seen in the third quarter stabilization in US biotech funding. We've started to see that flow through to expenditure, and that's really what's underpinned, as you said, was good results. Nobody could crib about the third quarter, 11% growth, back into that growth momentum. But it's a little bit later in the year than I'd originally expected when I set the guidance, and that then has that knock-on flow through. So what we'd said at the mid-year was we thought high single digits. I think it'll be single digits rather than high single digits. But it's not really a change in the direction. It's just a change in the timing of when the recovery started. It was a little bit later in the year than I'd really expected when I set the guidance. But we're back now into growth. Your question then was, what about the fourth quarter? I think you'll see that continuation of that level of momentum as we go into the fourth quarter. It certainly feels as though that's the sort of busyness that we've got on across the business. So that means that two good quarters as we go towards the year end of growth. takes us into single-digit growth for the full year. And then for next year's outlook, I'll do what I always do. I cover that at the full year results in April.
Well, you've maintained your EBITDA margin guidance of high 20s, 28 to 29%, what we're seeing. In Q3 FY25, margins are at 30%. So what are the synergies that will aid margins in second half of FY25?
Yeah, so the margin guidance for the full year, we reaffirmed pretty much the same as we had last year. We saw good uptick during the third quarter, pretty much as we expected. I think we saw 3 percentage points improvement, came in at EBITDA around about 30. And that sets us, I think, pretty much the pattern through the rest of the year. Drivers behind it, revenue growth was one. That's just operating leverage that comes from growing at 11%. And then within it, a little bit of mix effect, a little bit of movement away from some of those projects that have got higher raw materials costs. And then the final factor, just a little bit better operational efficiency and some good purchasing. We're driving very hard to make sure that we look at our own supply chain and that we really drive out cost of that where we can. So those three factors, I think, drove that improvement in the margin during the third quarter, and we're on track for our guidance for the full year.
Jonathan, what is the revenue contribution expected from the Mangalore API facility and the Stelis Biologicals facility in FY26, and any synergies which we can start seeing as early as Q4?
Yeah, I mean, you'll see it just rolled up into the business and the overall guidance. We don't guide by plant, by production line and segmenting that much. So you'll just see it rolled up when I talk about it at the full year. But just to be really precise around the Stelis facility, or Unit 3 as we call it, what we'd said is, having bought it, remember we bought it, it was a vaccines manufacturing plant, and that we were going to re-engineer it and invest in it and upgrade it to become a biologics plant. And we said that would take the year. And we're absolutely on track. That'll be finished this quarter. So I don't think there's anything from my point of view that's different from our internal expectations. We've put the CapEx into it. We're upgrading it. It'll come online, in this quarter towards the end of the year. And then it'll be open and ready to accept new client work. But that's headroom for growth. We've got to get out in the market, win those mandates from customers. So it's very much now about the sales cycle rather than the CapEx cycle.
Just a clarification, so FY26 is when we will see these facilities generate revenues?
Yeah, it'll be available for sale, as it were, from the beginning of FY26.
Okay, got that. What will be the positive trigger then, Jonathan, for the next 12 to 15 months? What's on the horizon?
I think it's pretty much a continuation of the themes that we've talked about throughout the year. We offer a broad range of services. We have the ability to meet a large range of customers' needs. So that capability and that productivity and customer service is still there. So we've got to remain competitive. We're seeing some structural shifts, as you know. The large pharma sector has got quite a headwind coming in terms of patent expiries. That normally drives them to think more carefully about cost and expenditure. And one of the ways that we can help them with that is we can do science that's world-class here in India, just as well as we can do it in Europe and the US. We can do it a lot more cost efficiently. And that's one of the things that drives our top-line growth. And then we move into the geopolitics. And there's been a general trend over recent years to think carefully around your supply chain risk. Where in the world do you get work done? And around that, we have this whole concept of China switches or China plus one. And I think that's a steady flow of work that's coming out of China. There's still some great firms in China, but I think people are rebalancing around that risk. And as it comes out of China, one of the places that people naturally look is India. And within that, leading companies like us, and I would say Syngene's well positioned to be a leader in that context. And that's another driving force.
Well, one very interesting talking point has been the likely imposition of the Biosecure Act in the US market. So with that, are you seeing increased RFQs, inquiries from clients? And what is the benefit you're expecting in the next couple of years? Or could you quantify it? And when will the revenue generation start from these particular contracts?
Yeah, I think it's happening now. The third quarter performance, that return to growth back up to 11%. Some of the things that underpin that are those China plus one contracts starting to scale up. Yeah.
You spoke about China plus one contracts starting to scale up. Any more such contracts? Any pilot projects you're working on?
Yeah, I hope so. We'll be out there every day, competing for our share of them.
Well, that was a very interesting conversation that we had with Syngene. And it's now time for the Growth Code, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll try and demystify the gap between retail and institutional players when it comes to access to algo trading.
एल्गो ट्रेडिंग
नहीं एल्गो ट्रेडिंग तो सिर्फ बड़ी कंपनीज को फायदा देते हैं.
इट्स लाइक अ रॉकेट साइंस. नहीं, ये सब मुझे समझ नहीं आता. मुझे तो हमेशा लॉस ही हुआ है.
By the time I set up my algo, the market has already moved on.
Algo trading has long been dominated by institutional traders. In financial year 2024, 96% of proprietary traders used algos compared to just 13% of individual traders. The results? Institutions made 32,000 crore rupees in profits, while retail traders lost rupees 1.8 lakh crore.
It is not necessary. In algo trading, you will be always a profitable trader. So this is pure myth. If institutions are using algorithm because they have a wide experience, they have wide data, they have different type of study material, which single person cannot go with.
Recently, SEBI proposed a set of rules that can open up safer and more transparent algo for all.
SEBI is particularly very keen with the unsolicited claimants who are claiming that they are giving the fixed rate of interest through algo trading. It should be in a very regulated manner.
For retail traders, the game is still challenging. But the new guidelines can help set better rules for a fairer chance ahead.
Welcome back. Picking up a bit for the frontline indices, ICICI Bank ahead of its numbers tomorrow is seeing some buying. Stock has moved up nearly 1%. HUL, after the drubbing it got yesterday post numbers, is rebounding nearly 2%. JSW Steel, Bajaj Finance are some of the stocks inching up. But we've got a corporate discussion lined up for you. MPS. Now, this company reported a strong Q3. Revenue surged nearly 5% quarter on quarter. Profits after tax also jumping 37%. We have with us Rahul Arora, Chairman CEO of the company, now joining in. Rahul, thank you for joining in. This is Rima here. So it's a strong quarter. You've clocked in a top-line growth of about 39%. I understand part of it, when you look at it on a year-on-year basis, is on account of the acquisitions. But what's the outlook looking? Because Q4 is typically a strong quarter for you. How do you expect Q4 to play out? And for each of the three segments that you operate in, can you tell us the outlook and the visibility?
Happy Friday, Rima. Thank you for having us on the show. So I think overall, back in Q1, we had given a guidance of 30% revenue growth and 25% EBITDA margin growth. So we are essentially tracking against that guidance. Q3, we've significantly made up for lost ground in Q1 and Q2, and Q4 will again be very similar in terms of us beating the guidance that we had shared, which was 30% revenue growth and 25% EBITDA growth. So in terms of the three markets that we're in, research, education, and corporate, all three markets, we have very strong plays. Our strategy, of course, for each of these markets is slightly different. For research, it's more about a value chain consolidation, whereas for education, we are shifting closer to the end consumer of learning. And finally, within corporate, again, we're trying to make a bit of a tech play. So all three markets represent significant opportunities for MPS, and we're very uniquely positioned to capture those opportunities.
So for next year, Rahul, are you in a position to give us a guidance on revenues and margins? Because margins already are now well above 30%.
Yeah, so I think we've shared earlier a guidance for FY28, which we call Vision 2027, which is to get to 1,500 crores at similar margins by then. And we are now on track. If you look at FY25 and where we will close out, we've caught up for lost ground. And I think pretty uniformly grow across those 3 years. So yeah, it's difficult to give guidance for FY26 right now, but very confident about FY28 and the 1,500 crore goal.
Rahul, one thing that you mentioned as far as Q3 is concerned, is that you signed a 3-year contract with a minimum ensured volume for tool usage. So with that, what is the kind of revenue visibility that is now assured as far as Q4 is concerned and FY26 is concerned? And if you could share more details on this particular 3-year contract.
Yeah, so it's obviously I can't give too much detail because we're covered by NDAs, etc. But essentially, the essence of the contract is we've been working with this customer for over a decade. We're in a very strategic position, and I think both parties realize that the next 3 years are extremely important. And we've basically arrived at a model where our revenue keeps growing year on year, and that allows us to unlock some economies of scale, and we've passed on some of those efficiencies to them. In terms of assured revenue, typically within the research market, 90% or 95% of our revenue is locked in ahead of the year. Similarly, in education, 80-85% is locked in. Within corporate, it's more 70%. So our business tends to be very predictable from that standpoint, and that's why our margins tend to be higher than some of our competitors in industry in general, because we're able to plan around the upcoming revenue.
What percentage of your revenues is linked to corporate spending? And is that because corporates were, it's a little tight-fisted when it came to spending over the last couple of years, given the challenges on the global front economy. Is that cycle now turning? And what do you expect on the corporate front?
Yeah, so corporate is much smaller for us now. It's less than 15% of our revenue. We have not, and maybe because we are small, we haven't seen that tightening just yet, but yeah, so we have little exposure, and within the exposure, our business is in fact doing very well. So we haven't seen that tightening. Perhaps when it comes to learning in a downward cycle, corporates do overinvest in learning and development. So perhaps that's the reason.
One reason for the strong growth has been inorganic acquisitions that you've done and you've completed successfully in the past. Are there any more inorganic acquisitions in the pipeline? We understand that you were looking to do one particular acquisition by the end of FY25. Is that on track? As far as the targeted entity is concerned, what will be the spend that you will go ahead and look to make that particular acquisition at? And what will be the revenue profile, margin profile of the targeted entity?
Sure. So as you described, we are serial acquirers. We tend to acquire 1 or 2 assets every year. In the next round, we are focused on the education vertical. The last time we did acquisitions in education was between 2013 and 2015, so long overdue from that standpoint. In terms of the type of assets that we're looking at, essentially we're looking at companies that are in the $15 to $30 million range in terms of revenue. Companies that have at least a 10 to 15% EBITDA margin that we can then come in and grow and improve. And companies that have synergies with our business that allow us to unlock revenue growth across the incumbent business as well. So overall, those are kind of the characteristics that we look at. In terms of where we're at, FY25 has been the busiest year we've had over the last 4 or 5 years in terms of the number of deals we've looked at. We haven't closed one yet, but as that happens, we would of course be here and reporting that.
Got that. Also, last year marked, for the last couple of years, you've been expanding into newer geographies too. So whether it's China, where you opened up your center, but New Zealand, Australia, Brazil, South Korea, what's the contribution of these newer geographies? How are they panning out for you?
So really good. So APAC is now roughly 30% of our revenue. I personally have relocated to Singapore to kind of spearhead some of this growth that we're seeing. We are very bullish on the region. So overall, North America used to be a majority of our revenue. Today, North America is more like 45%. I think looking out 2-3 years, we probably will be in a position where the Western world is less than 70% of our revenue, and the balance really is coming from Asia Pacific. I think some of the reasons for this type of growth include a market that still has to catch up with, specifically on education and learning, to catch up with some of the maturity that we've seen in the West. And MPS is kind of uniquely positioned to bring a lot of that into this marketplace with the IP that we have. Yeah, so we'll just keep going deeper within Asia Pacific over the next couple of years. I think we're very bullish on this particular geography.
Thank you so much, Rahul, for joining us. As we speak, the stock today is up over 12.5%. Clearly, the market likes the results and the commentary that you've just given us. Time now for a short break. We'll tell you why stocks like Syngene, Tejas Networks, and a whole host of BFSI stocks are buzzing in trade today.
Welcome back. One more stock under pressure today is Tejas Networks. Well, this is a company which makes telecom equipment for networks, etc. And they got this large BSNL order a few quarters back. So BSNL revenues had bumped up the company's quarterly performance quarter after quarter for the last 4 or 5 quarters. But this quarter, there has been a step down. So revenues have come down by nearly 6%. Margins on a sequential basis at 9.1% versus 14.3%. But even if you strip out those two numbers, because you don't look at these numbers on a quarter-on-quarter basis, right? There is a lumpiness when it comes to, so you often look at it on a year-on-year basis, and those numbers are strong because of that BSNL deal.
Right.
But the order book for the company, and that trend will come up for you on your screen, the order book was very strong for the last couple of quarters at 9,000. It's come down to sub 3,600. And secondly, even the trade receivables have been inching up for the company, and this quarter stands at 4,730.
So the lack of replenishment of the order book is something that the street currently isn't liking. Thank you so much, Reema, for taking us through what exactly transpired as far as Tejas Networks is concerned. But we also have Abhishek standing by. Abhishek saw a whole host of BFSI companies, the NBFCs, MFIs that came out with results yesterday. Abhishek, what are the key takeaways?
Rural market is in pain, and that was the key takeaway of microfinance sector loans. They continue to see deterioration in their asset quality at least for 4 to 5 quarters in a row. So Suryodaya Small Finance Bank, as a result of the stress, has cut its FY25 guidance. AUM or loan growth is now expected at 22 to 25% from 30-35% earlier. Net interest margin guidance has been cut anywhere between 30 to 50 basis points. Asset quality, that's a sharp increase in the guidance. Gross NPA ratio will now be below 6%. Earlier guidance was less than 2.5%. Net NPA ratio will be below 3.5% from earlier guidance of below 0.6%. ROA as a resultant has been declined to 1.4 to 1.5% range from 2.2 to 2.3 earlier, and they expect ROE of 10 to 11% from the earlier guidance of 14 to 16%. Ujjivan Small Finance Bank, the gross NPA ratio is at 7-quarter high of about 2.68%. Slippages are elevated and multi-quarter high 359 crore versus 238 crores. The annualized slippage ratio is at 4.7% versus 3.1%. Again, a multi-quarter high. The net interest margin for them has come in at 13-quarter low, and the return ratios, that is ROA, is at 12-quarter low of 1.2%. Spandana Spurti, the AUM has declined by about 14% YOY and 15.2% sequentially. The net interest margin has declined both YOY and quarter-on-quarter to 11.3%. They have written off about 678 crores. Just remember that their Q2 gross NPA was 477 crores. So the write-offs are much higher than what the previous quarter, gross NPA was. Return ratios, they are one of the worst in the industry. ROA at 16%, ROE at 52%. They have reported loss of 658 crore versus 203 crore in the previous quarter. Back to you.
Thank you very much for that. By the way, note the comments coming in from Mphasis in the conference call. The con call was at 11 o'clock, and the company is saying that Q4 will be the best Q4 that they've seen this time. Furloughs, which typically take place in Q3, but in bad times get extended into Q4. This time they're saying that is not happening. And remember, many analysts on the street believe that Mphasis is perhaps the best way to play the demand recovery in BFSI and in North America's strength, because this company is heavily indexed to the banking and financial vertical. Banking itself is 50%, plus you add insurance to it, and North America is about 70-80%. So if you want to play the recovery in banks, client spends, which is the only sector where confidently companies are calling out green shoots, then according to many analysts, Mphasis is perhaps the best play. But in the morning, the stock was down 5% because Q3 numbers were slightly lower than street expectations on revenue. But the commentary from the management about Q4 being strong and even maintaining that this year they will see above industry growth rates and they are prioritizing growth, that's what they told us. I think that's going down well with the street.
Thank you so much, Rima. A very, very sharp recovery, like you pointed out in Mphasis. Let's now slip into a short break. When we return, we will discuss market technicals with Mitesh Thakkar and also discuss his top trading bets. Welcome back to Trading Hour. Well, a lot more coming in from Davos. C. Vijay Kumar, the CEO and Managing Director of HCLTech, says business confidence appears stronger, which is translating into higher spending. Speaking to Shireen Ban, he adds investments in AI and sales are the top priority.
At this point in time, it certainly seems like the mood is better. There is more optimism, specifically with respect to the US market. That's the mother market as far as you're concerned. Yes. What are you picking up on?
Yes, certainly there was a lot of uncertainty and lack of clarity when we met here last year. But this time, even though some of the things are not clear yet, but at least people are, most decision makers seem to know that this is the direction things are going to go, because everybody's positions are clear and they want to plan. I think the biggest theme everyone is talking about is how do you become very adaptable? Adaptability to any changes, whether it is regulations or geopolitics. I think that seems to be the biggest theme, and I think people have also prepared to some extent because none of this is new, whether it is tariffs or geopolitics. So I think we are better, leadership seems to be better prepared to deal with the change that could be coming up.
And in terms of business confidence and that translating into perhaps higher spends?
I think so. There was a holding pattern when we met last time. And I think over the last 2 quarters, we already see the discretionary spend picking up. Financial services, we saw a good pickup in the last 2 quarters. Last quarter, even the technology and all other verticals, we see some good pickup. And I'm really hoping that this momentum will continue. And given all the conversations, I feel more confident now.
Well, speaking of the conversations here are all about AI in its different facets. You're going all in as far as agentic AI is concerned, and that seems to be the big theme for you here in Davos this year.
Yes. So, Shireen, the way we are looking at AI is, first and foremost, every service that we deliver needs to really benefit from generative AI. And that means we are proactively talking to our clients as to what is the art of the possible. If we believe we can provide maybe 25% more efficiency, we are not shying away from it. We are talking to them saying, this is the art of the possible. We need you to walk this journey with us. We have an amazing platform, AI Force, which leverages all the best of breed language model, small language model, large language model, agentic, all of that. And we are proactively implementing it. We already have a very good success for 6 large clients. And we want to roll out to 100 clients by financial year 26, which is March of 26. And that journey is going well. That's on the service transformation side. There is another very big area, which is the value stream innovation. Like if you're working for a bank, there is an opportunity. We built a solution for trade surveillance. We are working for a very large hospital for the physician assistants. So these solutions are what we're calling as industry-focused repeatable solutions. We have come up with about 70 solutions. All of them have at least 1 or 2 clients who are already using it. They're seeing the value, and we want to kind of build on it, right? Eventually, our business is a big part of our business is services. The way it will evolve is it's going to be more solutions. It's a combination of IP and services. That's the way we believe the industry will evolve.
Let's talk about your own journey with respect to your people and being able to adapt to the future and the future needs of your clients. How many have you already been able to train to deal with an AI world, and what's the outlook on that front?
So I think we have 2 programs. One is really the users of AI, right? They're not the developers in AI, which pretty much everybody in the company needs to be a user of AI. Very large percentage of our teams are already trained as to use some aspects of AI, whether it is GitHub Copilot or other M365, many other things. Now, there is also a set of people who are building new applications, fine-tuning, LLM ops, all of that. I think we have about 4,000 people who are very capable to build, engage with clients and who are architects and things like that. And they're also significantly deployed in the 8 labs that we have built over the last maybe a year or so.
Done the quarter, so I won't go back to the numbers, but essentially I want to understand from you, the margin trajectory from here on. You've seen 20% kind of margins. You're below that at this point in time. When do you anticipate being able to get back to that?
So we have a program called Project Ascent, which is really geared towards improving margins. And this quarter, we almost had 100 basis points benefit. But Shireen, while we are significantly gaining from those programs, we are also investing a lot more in AI. So we are more focused on making all the right investments than necessarily delivering maybe a 1% higher margin. And we are also we're not covering the entire market. We also need to invest in sales. So that's another area of investment. So definitely a lot of improvements are happening, but we are investing for the future. And even on the other front, right, it's not about just everybody is chasing growth, but the most important thing we are focused on is to client relevance, because the world is changing so much, technology is changing so much. The existing operating model is not going to take us to the next few years.
So what will have to change? And that brings me to the very important question. 25 done. Let's look at the future over the next 25. What is no longer relevant, or what is sell past its date, past its sell date at this point in time as far as the next 25 is concerned? Where will you need to make changes as far as the operating model is concerned?
I think the model that has been extremely successful, I think the time has come for it to be disrupted. IT services as a business, I think we are at the cusp of a very big inflection point.
Okay, we'll slip into a short break on that note. Interesting conversation as always. We'll get you more on the market. Stay tuned.
Welcome back to Trading Hour. Well, the rebound as far as IT stocks continue. Mitesh Thakkar now joins us for a quick technical check on the market. Mitesh, good morning. Thank you so much for joining us. Give us your view on the indices as well as any stock-specific picks that you have for the day.
So, good morning. My sense is that we have, kind of bounced back from the lower end of the range, which was around 23,000, which we hit on Wednesday. And now most likely are trying for the upper end of the range, which is around 23,370 odd levels. So we are probably about 40 points away from that. If we can manage to sustain above that, and there's certainly a chance of that, then I think we might even do 23,500. So for the time being, staying positive, despite the fact that the morning session was slightly on the volatile side. On the stock side, Birla Soft is a buy with a stop at 545 for targets of 580. That's the first target. We can eventually look at slightly higher levels as well. And Coforge is a buy with a stop at 9,200 for targets of 9,600.
Thank you very much for that. Midcap IT all the way. Birla Soft and Coforge, and Mphasis is now up 5%. Remember, it started trade down 5%. Get into a break. We'll come back with more. Welcome back. The stock to focus on today will be InterGlobe Aviation as it comes out with numbers, and Vinny joins in with the expectations.
Yes, so in terms of expectations from InterGlobe Aviation, we were expecting the revenue to see a growth of around 13% on a year-on-year basis. Margins expected to see a bit of an expansion YOY, 100 basis point expansion is what we're expecting, and profits expected to see a 5% improvement. Yields also expected to come in at 5.48 rupees versus 5.46 rupees last time. So yes, that's something important to watch out for, remaining quite flattish on that front. But passenger load factor, that's supposed to come in and expected to come in at around 86-87%, and overall there's an expansion which we're seeing in terms of margins. Why? Fuel prices, obviously, that is lower fuel prices, as well as the profitability improvement is also because of lower crude prices, fuel prices that is coming in, and especially it's a seasonally strong quarter. So because of that, profitability is also that is being supported by both these factors. Now, other than that, the available seat per kilometer or ASK is what we talk about is expected to see a double-digit growth, which is reflecting the higher year-on-year basis growth in terms of the passenger load factor. So important to watch out for InterGlobe Aviation's numbers as well as commentary that we may have in terms of Pratt & Whitney engine that is there and fitted in the aircraft. What is the outlook on that front? Competition commentary as well as international expansion commentary will be key to watch out for.
Thank you so much, Winnie, for joining us and giving us a neat preview of what to expect from IndiGo's earnings. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.